Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. Learn from their experiences and navigate the highs and lows of the investing world. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. Today, my special guest is a gentleman named Larry Pendleton. Larry is a real estate investor. He's a tax and investment coach and founder of PC Financial Services. His main mission there is to help people find financial abundance by increasing their passive income and reducing their taxes with effective tax strategies. Larry, thank you so much for taking the time to be here. I appreciate it.
Thanks for having me, Benson.
Yeah, we were just chatting and you just got back from a really exciting 2-week-long trip in Bali. How amazing was that? Did you work at all, or was it just let's go and enjoy ourselves?
Try to disconnect, but it's it was difficult too. But I'd say we probably spent 80%, 75-80% of the time like not working. So but enjoy the trip and probably go back in the future.
Yeah, I mean, as an entrepreneur, it's hard to disconnect because you're always thinking about all the stuff that you're responsible for. And this is why we work with nights and weekends. And, as a CPA, did you ever work for, like corporate America, or have you always kind of been on your own?
No, I started off in public accounting, mostly a regional accounting firm. I know people know about the Big Four, the KPMGs and all that, but I was more so in line with a smaller local firm here. Done that for nearly a decade before starting to kind of branch out in the corporate in the corporate world into different internal audit and tax departments, while starting PC Financial Services and building from within there.
That's cool. So now you work with a lot of investors. Was that like a conscious decision to try to niche yourself to work with investors?
Yes, we're me and my partner Terry Conyers. We're both investors. He's a Class A contractor as well, and we started kind of to everyone else, small single family, and started to build up. And took a mentor to slap me across the head and say, "Well, you're doing mostly real estate. Why not just service other real estate professionals and grow from there?" So yes, being niche was in real estate was key to why we wanted to kind of build our real estate portfolio as well.
Yeah, I can see that being a huge advantage as an accountant, where you speak the language of the investor, right? You're not just a CPA and got all these different businesses coming in and it's just like normal tax stuff. But real estate investors have a lot more going on with their taxes, potentially with depreciation and with cost segregation and with cash flow, passive versus active. I can imagine that you're being able to take the stuff that you've done in your business and helping investors apply that same or similar strategies to lower their tax burden. How is that? How does that work for you?
No, I like to pride myself in kind of being in between the geeky accounting world and the sexy investor world. Like
Mm-hmm.
I say, I can play on both sides, especially with our clients who have bookkeepers. So I'm able to speak that language and convert that into, "Hey, here's how it's going to affect your investments, as well as how it's going to affect your taxes as well." So try to be that middle point of let's bring this down to layman terms. It's not talking IRS code all the time, and break it down so people can understand. My feeling is that the better people understand, the more like they're actually going to follow in a certain direction that'll be best suitable for them.
Mm-hmm. Oh yeah, I think that there's so much strategy that can go into it. Like, as real estate investors, we're always deal driven, so we're always searching for the next deal, and we're going to make money from different kinds of strategies. But I don't think a lot of investors think about the tax side of things. Like, you keep more of what you make, and realistically, you could make more with a really solid tax strategy in place, like keeping more, like net more than if they were just really worried about more bringing in more deal flow, right? Like more deals, more deals, more deals. But like, yeah, you want more deals, but if you're not keeping that money in house because you got a poor tax strategy, then you're losing money.
Yeah, and it's also the right type of strategy as well, to what is not just do a deal just for the sake of doing a deal, or understanding how that deal may be different from tax wise from this deal over here, especially if we're talking about flipping properties versus rentals. Like they're completely two different worlds. So it can get rather niche within real estate itself when it comes to tax strategies as well. So it's just kind of based on individual, what they're looking to accomplish, and making sure, okay, well, you need to go down this path because this is really what you're looking for.
Right. And then like the tax strategy is just one piece of the overall financial strategy, which can include everything as basic as just like which like corporate structure to get, right? Like, do you go
Right.
with an LLC or a C corp or an S corp, and what will give you the best tax advantages for the specific revenue strategy, like passive versus active? So, how do you determine what the best thing to do is? I'm sure you're for a lot of the times, like you're coming in after the fact, like they've already
Mm.
got their business, set up. Do you come in sometimes and you're like, oh my God, we've got a lot of stuff that we need to reorganize, almost like a fix and flip, where you come in
Yeah.
there and you got crooked walls and you got to, you know, go back and try to make everything straight again because, somebody messed it up beforehand.
Yeah, that happens quite a bit, and more often than not is due to people overcomplicating it on the front end, and starting with these elaborate structures that don't do anything for them, because one, they may not be making enough money for it to actually be beneficial, or it's costing them more than the actual tax savings. So I like to, like, let's break it down. Let's keep it simple to what you actually need, and then let your entity structure grow with you. Um, if you're going to do an S corp election down the road, or if it's going to be a C corp down the road, but overall, I always want to make sure that, 'cause any tax strategy comes with a cost. So like, is this additional cost where the additional legal fees or compliance fees, do the tax savings outweigh that? Let's start with that first. If we can figure that part out, then all right, everything's going to be aligned from there.
Oh yeah, for sure. I mean, there's H&R Block's not going to figure it out for you, right? Like they're good for the normal W-2 employees to go and just take their taxes there, get them handled real basic. But, somebody like you with experience and you've worked at, big corporate America companies, type companies, the big four kind of companies. And so you've seen all different sides. So your specialized knowledge can come in and help save them thousands and thousands of dollars. Where do you see some of the biggest mistakes that people are making right now? And maybe it's like just not knowing what they don't know, but maybe just doing the wrong things.
Yeah, I think a lot of times there's a lot of assumptions of just LLCs in general. We're like, hey, LLCs help me save on taxes. We're like, LLCs actually do not. They don't. It's an asset protection mechanism, and it's really good at that. But it doesn't save you any taxes. So it's okay. You should get it because you want the asset protection if you have properties under your name or under your business name, but it doesn't initially save you any taxes. So the actual issue comes in was like, okay, they got the LLC because they want to do the S corp election, thinking that's going to help them save on taxes that way. But depending on what you're doing, all right, well, if you're just owning rental properties, S corp is not going to help you. So you're now paying for this additional tax return, all additional compliance stuff for this entity structure that isn't saving you any taxes, because your rental income isn't subject to self-employment taxes, which that's the main reason for the S corp. If your income not generating that type of income that's subject to FICA taxes, it's not helping you that way. And then on the other end, people who are flipping properties or doing more active businesses, they may not know when to do it, or they do it too early. Whereas, okay, well, you're not making enough money for it to make sense, or you just didn't know about it, and now we're trying to get you caught up so that, hey, you're now saving on that 15.3% self-employment taxes, that from being a real estate agent or broker or contractor, property manager, so forth and so forth from there. So it's kind of having that base LLC from asset protection, and then knowing when to, or if you need to do certain S corps, or if a C corp may be beneficial down the road, as your business grows.
Mhm. So there's a law changing this year. I think it's in September, having to do with disclosure, where a lot of people were getting certain entities in place so they could have privacy. But this new law is going to make us disclose all of our entities and who owns what, right? I can't remember what it's called. What's it called?
Corporate Transparency Act.
Corporate Transparency Act. How do you see that playing out here? Is it something we should all be really concerned with, or is it something that people are just making, bigger problem than it really is?
It definitely be something people should be concerned with, because there have been states trying to, well, I won't say state, but people trying to battle against it, saying it's unconstitutional, but no one has won yet. So for those that are now aware, if you're considered a significant owner of a business, most likely 25% ownership, make sure you're getting with your attorney, because you may have to report a beneficial ownership interest report, a BOI report, to FinCEN. So this is the sister company of the sister entity under the government beside the IRS. So they kind of handle their claiming is more so dealing with uh more so legal actions, not so much in the tax world, more so just, hey, we got money laundering, we have trafficking, stuff like that. They're trying to battle there. Significance is rather big because it went into effect January 1 of this year. If you have created an entity before January 1 of this year, you have until December 31st of this year to
Mm.
file for each of your entities. And if you don't, it's a penalty per day, like $500 a day, and potential jail time as well. So the penalties and the issue is rather significant, as we get closer to this year end. But also keep in mind, if you're creating the entities in 2024, you only have 90 days to file, so you don't have that December 31st deadline. So because a lot of people just create a whole bunch of entities, they try to create entity per property or per business, and okay, you may have a whole lot, and you got to file for each one. So make sure you're getting with your attorney, because there's definitely some legal ramifications involved, as well as align with your tax expert as well.
So what triggers any sort of inquiry from the government to look at somebody? Is it when they actually like file for the creation of the entity, or is it getting an EIN, or both? What would trigger that?
Well, that's kind of the combination of the two. If you're registering your entity, you're getting the EIN number, so that would trigger your requirement um to file this report with FinCEN.
And what's that agency you just said, Finsiv?
Yeah, FinCEN. I can't remember what the actual FINC CEN.
There's an
So
acronym for
yeah,
financial
I can't remember
services
what
something.
the acronym stands for.
Okay.
But it's under the Treasury Department, which includes the IRS, but within that is FinCEN as well. So they're more so claiming that they're trying to get drug trafficking, sex trafficking, and all of the criminals and stuff from that end, because all these entities were created throughout COVID, especially all the COVID money that was been issued out. So they're trying to, hey, who actually owns the entities? And to your point earlier, people did this to protect their identities, and even though it's supposed to be kept, but then the federal government, all right, you have one leak that happens, and now not everyone knows who owns these entities at this point. So because there are people that have been bidding for the information.
Right. So what do you think the real purpose of this new law is? Is it about control, or is it about money? What's the angle?
I mean, all of the above. There's definitely a control aspect of it, and I do believe there is a point of like, hey, there's criminals own these entities, and they try to find who they are. I do believe that's part of it, but it also just creates more control over the non-criminals, they're all of us, they're just kind of running legitimate businesses and just wanting to protect our names or protect our assets and keep our names out of public light, from that standpoint there. So it's always going to be a control aspect of it, because they're going to know like who the money part, they're going to get the money part from the IRS side. It's the control of it from the fence in side of it.
Right. And I mean, with $500 a day, I mean, we're talking about billions of dollars in revenue
Yeah.
they're likely going to be able to generate from this. Because I think for the most part, people just aren't even aware that it's a thing. Like, there's going to be so many people who just don't know. They're going to have huge bills piling up that they're going to have to pay. I mean, do you see that being a huge issue? I'm
Yeah,
aware of it, but that's because I pay attention. But I just don't think that most people do.
yeah, and the problem is like there's not going to be a daily invoice that comes from the IRS. So it's going to be days, weeks, months before some people even get, hey, a statement, hey, you haven't filed your BOY report. It's it's June 2025, and now you gotta accumulate 180 days of penalties. And so that's the next piece there. Like, how are they going to be reminding people and getting information out there? So like I said, that's why I tell people it's not just your tax person, but it's also primarily your attorney as well, because these are more legal matters, especially for these entities they're just creating, for these companies they're just creating entities for people. Like, they're on the line as well, and like, are they reminding people of this, of this stuff as well? So it's more people should be talking about it more and just keeping people in the radar. We try to keep our clients up to date with it as well and make sure we're online with their attorneys, so that, I mean, so that we can start getting stuff filed, for the end of the year.
Yeah. I just see there's going to be a huge problem. The only thing that, because they typically don't have contact information aside from just the mailing address, right? So they're going to be sending a lot of mail to people, but even so, like, I get stuff, it looks like spam mail, right? It looks like an ad, or it looks just doesn't look official. I mean, I don't know what I'm throwing away sometimes. And so sometimes people are going to, they're going to be accumulating these huge bills. And I don't know. I just anticipated it being a big problem for a lot of people.
Yeah. Yeah, like I said, it's definitely going to make up for a lot of the money that was spent out, because I mean, stuff fall to the cracks. Like, I mean, people just have LLCs like sitting around. They may or may not be doing them, or they just not aware of this, because they're not around the right people who are talking about this stuff as much as they need to be.
Yeah. So, Corporate Transparency Act, we talked about, some of the other strategies, tax strategies, and some of the things that people are making mistakes. Like, what do you think is just a good approach from a tax strategy perspective for investors overall? Like, obviously getting with someone with like you who can guide them, but is there anything generally that everybody should do?
Solid bookkeeping is not it's not the sexiest thing, it's not the funnest thing to talk about, but that is the base of your tax strategy. Like making sure you got your income and your expenses in line there. Whether you're doing it yourself with a spreadsheet or accounting software, or you're paying someone to do the bookkeeping for you, it's just making sure that's all in line. Make sure you got your receipts and invoice, because all of that supporting documentation is the basis of your tax strategy. Then
Hmm.
from there, there's, okay, like, now we get into these different things, that people talk about the most, talk the most about, but a lot of times, if the bookkeeping is not in order, that holds up so many different things that people are able to do.
Yeah, it's the basics, right? I mean, that's where it all starts. I mean, if you're tracking your income and your expenses, the expenses part for me seems to be the thing that where people can get into trouble because they want to put everything that's an expense into the deduction category, and it's not, right? So what are some of the best places where people can save on taxes by putting the right expenses in the right deduction buckets?
Yeah, I mean, it's how you reinvesting back into your business. Okay, are you doing the marketing? That's fine. You're doing travel for your business. Meals, I know that one point a couple of years ago we was at 100% meals deduction. We're back down to 50%, but just booking meals there and you eating by yourself is not going to count. Like just getting the right business meals with people uh in there is going to go a long way. Like your home office becomes a factor. Your mileage, how are you tracking your mileage? Everything should be done digitally. So it's just like nobody should be kind of be tracking this stuff manually. Using technology to your advantage is huge for this example for everybody at this point. So
Mm-hmm.
so I try to tell people like it's not so much of like what is it necessary or ordinary for your business? Like is this going to be needed to help your business grow? If so, like yes. So you try to align stuff where like, hey, you're meeting more people or you're hiring more people, you're buying more assets, equipment, so forth, so you can build your business. Like those are things that's going to get you the deductions that you're looking for to help offset, because that's what the government wants. They want people to use their income that they're making to reinvest back into their business, and that's where deductions come from. We have more
Mm-hmm.
we have more of a consumption tax. If you're not using your profits to reinvest in your business and buy investments, then you're consuming it through other means for personal means, and that's where they tax you at, because you don't have the expense to offset that income. So once you
Right.
have that kind of understanding and focus in place, then you start to, hey, let me start to put more here. We start to kind of align. Hey, I need to buy a bigger property here, or I need to buy this tractor for my contracting business, so forth and so forth, to help offset your taxes from there.
Yeah. Yeah. You mentioned, using technology as a way of, streamlining the process, but there's still this weird thing about saving receipts that I've never understood. Like, why is that still alive? I mean, I can go through my bank account and I can see every single amount of money I spent, where I spent it, the date. It's all there. Why do people still have to save receipts?
Because sometimes the bank statements and credit card statements aren't really fully accurate to what was actually purchased. For example, you you can go to Lowe's and have a Lowe's receipt, and then you can show that on your credit card statement, but was that all for business purposes? You can honestly go to Lowe's and get personal stuff as well as business stuff, and like that's the type of detail that they really want to see from there.
Mm.
Walmart is a huge example where like you can go there and get groceries and you can get a lawnmower to cut your rental property's grass, but like then that's that type of detail isn't really broken out on credit on bank statements and credit card statements. A
Mm.
lot of times you can, especially if it's primarily a business card that you're using, and you can get a lot of details. So like you can get a lot of it from the statements. It's just that until the details, the descriptions get more get more finite, then it's gonna be a requirement. And I said primary if they're calling the question or you ever audit from that angle.
Right. Yeah, and that makes sense. I can understand that now that, if with the receipt, it's harder to make a case that like normal everyday stuff that we use in our own lives is actually a business expense. Whereas if we're just looking at a line item on a bank statement, then, it's everything's in one thing. But yeah, that makes sense. But like you're right. Like, so one of the good things that people should do is to save their receipts. There's some cool apps out there where you can take pictures of receipts and it logs it, and you can put that together with your bookkeeping and give it to, your tax preparer at the end of every year. Right. It's probably a good practice.
Yeah, it definitely just makes it so much easier, and then you don't have to worry about losing receipts and them getting faded or damaged. Just put it to the cloud or whatever folder, Google Drive folder you want to use, and it's all there. Because really, your tax person is not going to go through all your receipts. It's primarily for just in case the IRS comes knocking and want more details. Now there
Mm-hmm.
may be things where it's like, hey, you have a large purchase. Let me take a look at the receipt. But for the most part, most tax advisors and tax preparers aren't going through every receipt. It's more so of having it just in case it has to be brought to light and proven, because the burden of proof is on the taxpayer.
Right. So you brought up something important here, which is an audit, right? Which is like one of the worst words in the English language, I think. Um, what are some of the things that people do that trigger audits? Like some of the things like, man, if you do that, you're gonna get audited.
Yeah, I mean, there's always going to say like the income aspect of it, where people don't realize like if you're getting K-1s or 1099, especially if you're getting W-2s, the IRS knows the income that you're making because whoever issued you that document has to issue a copy to the IRS as well. So you could just you not reporting on your income could trigger audit or trigger. It always start with some type of IRS letter, and then it can grow into an audit if it's ignored or if you just keep pushing back from that standpoint.
Mm-hmm.
Also keep in mind that depending on the type of business that you're running, if you're showing a certain expense line items that don't make sense for your business, that can trigger audit as well. For example, I have a tax business and I have a real estate business. If my tax business has a lot of mileage, that does not make sense because, like I said, what am I driving from that standpoint? Now, my mileage makes sense for my real estate business because I go see properties and all that stuff as well. So, depending on the type of business that you're running and you're showing a certain expense line item, it may not make sense to what you're doing from there. So that can trigger some additional investigating by the IRS and seeing where you got everything tracked at from there.
Mm-hmm. So do you have any good, without really, privacy being an issue here, like horror stories of people just totally messing up the process where they were, taking the wrong deductions, triggered an audit, got big fines, went to jail. Like, do you have any stories for us?
Yeah, there's always stories of in people who are trying to claim real estate professional status. And for those that don't know, I'm assuming a lot of your listeners do know, are like, hey, you can claim real estate professional status if you have your rental properties creating losses. You're not able to use those losses to offset your other income from your W-2, from your active business, so forth and so forth, which you can't do that before if you're not a real estate professional. Real estate professional is probably one of the most highest audited areas from the IRS because of how beneficial it is if you're able to get a cost segregation study, front load a whole bunch of depreciation and claim all these huge losses in one particular year. So um and and like I said, I have a client where he came to me after the fact where it's like he thought he was able to claim it, but he didn't have like the proper support of the time log in place to prove that he was a real estate professional. And what ends up happening with the IRS is that once they find one thing, and when it's never the next year, it's always 2-3 years down the road where it's okay, you've completely forgot about it and think it was good to go. Like they'll come back to that year, and once they start pulling on one thread, they start looking at other things as well, and they start questioning all his other expenses. It's like, hey, well, you're not a real estate professional, and we don't, and you, and we can't, and we're not going to allow all the additional expenses so that you can provide support and documentation for him. So now he's in a frantic mode trying to um, they're now digging back in the previous year. They start with 1 year and they start kind of keep pulling that thread. And they start like, hey, well, this doesn't look right. This doesn't look right. This doesn't look right. So that's a terrible situation of for him, primarily because his tax person, I be quite honest, just didn't tell him no. Like you don't qualify for this. And I think sometimes people need to hear that is no. Um, Having the tax advisor doesn't mean someone who's just going to be saying yes to everything that you want
Right.
to do. I consider myself aggressive, but it's like, hey, I gotta have the proper support in order to be aggressive. because you're dealing with 7 years of audits, and having to file all the documentation and getting tax attorneys, and the cost of it is just mounts up at that point. So that's stories like that was like, it can get bad if you're trying to qualify for certain things but don't have the proper documentation to know where to claim it.
Yeah. Do you know what that criteria is for someone to be able to be qualified for that?
Yeah, so for real estate professional status, it's 750 hours in a real property trader business that you at least own 10% of. And more than half your work time is in that real property trader business. Because the
Mm,
750 is difficult, but it's not that difficult. It's like 60 hours or something like that a month, 40 hours. I can't remember the exact number at the point right now. But it's the more than half your work time. That's the part that trips people up, because you can
mm,
you can't sit there and tell the IRS you have a full-time job, and they automatically assume that you have a full-time job, that you're working 2,800 hours in a year. So it's like to sit there and say you work, or I'm sorry, 2,000 hours in a year. So to sit here and say that you work 2001 in real estate, and you have a family, and that's so that's a lot of hours in a year, including weekends and holidays, to sit there and now your credibility is questioned, because now I say, well, if you're lying to us, you're probably lying to your employer as well. So that's a key part of the realtor professional status.
yeah.
Now the other part of it is that, okay, you got realtor professional status. Do you have rental properties that's generating losses that you can use? And that's where material participation, because we have a lot of real estate agents, we have a lot of brokers, we have a lot of contractors. They're real estate professionals, but it doesn't mean anything if you don't have losses from a rental property that you are material participating with.
Mm,
And material participation is the same as real estate professional status hours, but it's only related to your particular properties that you own, and that you affect the daily operations of as well. So it's a two-tier test of why real estate professional status becomes beneficial, because it's one step closer to, once you buy the rental properties, in order to use the losses to offset your other income.
yeah, I can see there being a lot of boxes to check in that scenario and difficult to get that qualification, I'm sure. But once you
Yeah,
do,
yeah. I think once you, it's really tedious, because it's like, that's like you're really tracking your time as if you're like you're an hourly worker. Because part of the IRS audit guide, number two, number three, is probably like, let's see the time law. Like, they want to see the time law. They want to see not just, hey, I did 8 hours of real estate stuff. Like, no, they want to know each individual thing that you did for that whole year, and you got to do it year by year. But you
yeah,
got to qualify for year after year after year, if you want to if you want that benefit from it. They make it rather difficult. They rather make it tedious on purpose, because they know the average person is probably not going to be able to qualify for it.
yeah. But also it's just scaring people away from using it, right? Oh yeah, we're here to help, and we got this really cool real estate professional thing that you can do, and it's like the government trying to like make them think that they're on your side, but really it's just they know no one's going to qualify for it anyway, so it doesn't hurt them because they want all the they want all the tax money,
Yeah,
right?
it's primarily for like high net worth individuals who they maxed out their retirement account, they got the HSA, they got the kids, but the tax code isn't made for employees, so like you're capped out at some point. So they know that a lot of high net worth individuals, doctors, athletes, they'll buy rental properties, and those rental properties, they're going to create a year one loss at least, even without a cost segregation study. But they won't be able to use those losses in that particular year. Now they'll be
Hmm.
able to use it down the road once they're showing passive income from those properties, but that's not helping them with their tax burden now.
Right.
So it mitigates high net individuals from just throwing money at places and claiming losses without doing anything to to show that they're actively involved with their rental properties.
Right. And then earlier you mentioned something about like, the IRS maybe thinks you're lying to them, but they don't make any sort of distinction when there's a mistake, right? Whether you were lying or whether you just messed up, it still resulted in an error, and they look at it the same way, right? There's no, auditor who's going to be like, oh, well, you clearly didn't have negative intentions. Like, you just messed up,
Yeah,
right?
if
So
there's
we're going
if
to give
there's
you
an
a slap on the
error,
hand. But if they think you're
yeah, so
lying,
yeah, it gets
that's
worse. So yeah, if they because when they come and talk, they can determine whether or not if this was just an error or this was something more egregious. And
so they
then
do have some subjectivity there to be
yeah,
able
yeah,
to.
they do have some subjectivity where it's like, hey, this is an error, like found it, or we can remove it and we can keep moving from here. And it's like, hey, there's still probably some penalties, but it may not be the additional pulling of the thread to see what else is behind the scenes or more information they're requiring from there. So it's like, so if you're having to get involved, like I said, you can. I mean, they're human. I mean, they're like I said, they're not all robots. And most of them are really good people. They're just following the guidance or their audit guides from that standpoint there, but they're they could be talked to and like, hey, reason with if everything is up to par. It's just like, hey, a mistake may have been happening here and it wasn't egregious or some fraudulent that was trying to happen.
Right. It sounded like that might be the case of the previous example you were given of the guy who thought he qualified for the real estate professional category, but really he didn't. And so, he found out the hard way.
Yeah,
But
then like I said, then like just a lot of excess expenses. I said with meals and travel, and I said that kind of built up, and that kind of like I said the with no supporting documentation, and like they just kept pulling the thread, and just now just turned to like multiple years that they end up looking at.
yeah. Have you ever known anybody who had to go to jail because of tax fraud?
Unfortunately, no, I have not.
That's good. And not that they're like your clients, right? I'm not insinuating that you were part of it, but like you run in circles, right?
Right.
And
Like no, I mean the one person it was actually he was actually a tax preparer.
mm,
Uh, and I'm not sure that the more money taxes reference rings a bell at all. But it was kind of one of those situations where he was just making fake LLCs for people and give them all or fake businesses for people and give them all these write-offs for their businesses that they were never running from that standpoint. But he got a significant fine and basically barred from ever repair taxes again. But he didn't yeah, no jail time for him though.
yeah, you hear about that from time to time. It's always somebody famous, right, who goes to jail for tax evasion or tax fraud. Like these celebrities. I think of
Yeah.
man, what was his name?
Wesley
Cuba
Snipes.
Gooding Jr. got in trouble with the tax man. Um, Wesley Snipes, is that who you
Yep.
just said?
Yep.
Yep, Wesley Snipes too. Yeah, it's a lot. I mean, I can see that for sure. A lot of people are making money, and especially if there's a big windfall, right? And they haven't planned for it, and all of a sudden they just become famous overnight, or they get a big hit, with something, then they're not prepared, and something bad happens. But you mentioned like that CPA or that tax preparer who did something wrong. Like, is there like a whole world of tax preparers and CPAs who are who operate like almost in like the bad side of the line, right? Like they say, work in the gray. But I can see, if I was, a CPA and I got a high net worth individual and they're be willing to pay me more money, I could find some ways of, tiptoeing that line a little bit closer, right? Is that something that happens?
I mean, we all work in the gray, and that's why I try to get people early. Like, say, if you're willing to pay me more to try to get stuff worked around, then you might as well have paid me to be before the year has started, and then like that's a deduction for you there. That's kind of the way to do it, where it's like it's not going to make sense where like you have this short term benefit, but now you got this cloud over your head, and you just never know when they're going to come asking, like come knocking on the door. And then from the CPA side, it's not just a risk for just that one client. If it becomes like, hey, well, let's look at your other clients as well because you should have known better. So now I'm putting all my clients at risk of being audited because of what I did for a few extra dollars for this one person. Like I said, so
Mm,
it's honestly not even worth it in the long run. Try to go from being, because like I said, we try to operate in the gray as much as possible because there are stuff that's not clear at all. Like the IRS code is now 100% clear on everything. Like even they have back and forth when they do their amendments and stuff, and changes to the tax code as well. So it's all just interpreting what it really means from that standpoint. So it's like that
yeah.
that the gray is going to happen, um, or the type of work that's being done to claim for real estate professional status. Okay, like all right, like what, like could this actually fit into this category? And it's like, hey, well, there's still real estate property, like lawn care. Like I said, it's not a contractor or agent, but like, hey, the purpose of that business is to take care of real estate. So you have situations like that where like we do have to operate in the grid, but do we have enough support and documentation to shine some light on it to say here's an opportunity that we can take advantage of right here?
Right. So what do you think is one of the most like less utilized or under less understood strategies that people just aren't taking advantage of? It could be for any business, maybe not just people who are in real estate, but entrepreneurs, who are operating in the gray. What's one of the things that most people just don't know about or don't use?
I think the solo 401k is one that a lot of sole proprietors, before they start hiring employees, um is not really utilized, especially separate from rental properties and I mean just any business itself, where like, hey, you can get a larger deduction for these contributions. And I think the concern for a lot of investors is that they don't want to put their money into Wall Street, which
Mm,
is we could have a whole separate podcast on that. But if that's your concern, then it's like, hey, well, you need to learn more about self-directing retirement accounts then, where like you can actually set up this for your business and get the contributions up to $69,000 as an employee and employer of your business. But now you can self-direct that into whatever you feel comfortable investing into, as long as it's not prohibited transaction. So I think that solo 401k is a huge missed opportunity for a lot of business owners.
awesome. Thank you for that tip. Um, well, Larry, I mean, you are a unique CPA, right? I love the aspect that you are operating between these two worlds of being a CPA, but also understanding the real estate investing. Um, if anybody out there is looking for a CPA who could help them with these unique situations, then definitely consider Larry. But Larry, where could they find you? You got this QR code up in the upper right-hand corner. Where can they find you online?
Yep, the QR code, www.larrypendletoncpa.com. You can find me there. I'm on Facebook, I'm on LinkedIn, I'm on Instagram at Larry Pendleton CPA. So try to make it obvious as much as possible. But yeah, mostly all social platforms and the web and the landing page as well. You can find me at.
Awesome. What would be your final thoughts for this podcast today? Anything to take away for people?
Um, don't let the tax tail wag the investment dog. That it's almost a bit cliche there, but it's like, hey, like just because some deduction, like it just financially makes sense for you. A lot of people started going out and buying G wagons and and big fancy trucks, during the pandemic when we had 100% bonus depreciation. But all right, that comes, you're going to pay for cash, you're going to pay a note for it. Yeah, you got this year one deduction, but now does this financially make sense for you there? So it's kind of aligning your financial vision along with the tax strategy and making sure they work together, because they can clash at times and just to write off stuff. Now, if there's emergencies that come up and you say, I don't want to deal with this huge tax bill. I know people like to talk about Grant Cardone buying a jet for his business, but there's a lot of additional costs down the road with stuff like that. And are you willing to, one, keep track of that stuff, as well as your business financially stable enough to keep up with those type of expenses, because it's just not just a 1-year thing. So it's being mindful of like, hey, yeah, let's take advantage of what we can. Let's make sure it makes sense to what you're doing, and not just pay for stuff for the sake of a write-off if the tax savings aren't worth the cost.
Yep. Great point. Well, Larry, thank you so much for taking the time. I appreciate you. Looking forward to you guys reach out to Larry if you got questions about your business, setting up, the proper entity structures, tax preparation, financial strategies. And for those of you who are just, checking out the podcast for the first time, thank you for checking it out. Keep an eye out for future guests, other real estate professionals, investors, service providers, mentors, coaches, anybody in the space who really understands a different perspective on what's going on out there. But thank you for listening, and keep an eye out, and we'll see you next time. Take care.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.